Chapter 17 covers the statement of cash flows. This is the fourth of the four financial reports. You learned the first three financial reports very early on in the course. You learned the income statement, the statement of owner's equity, and the balance sheet. This is the fourth and final report that is prepared. We didn't learn it at the beginning of the class because there was a lot we needed to cover. You needed to have a better understanding of the accounting system and the recording of transactions before we could tackle this statement. So here we are. This first problem is providing us with a list of transactions that took place during a recent fiscal year. Our job will be to, well, they didn't give us the instructions here, our job is going to be to indicate where it is reported on the statement of cash flows, and the cash flow would be an inflow, an outflow, or if it would have no effect. Okay, I'm going to go ahead and just bring this up. Okay. All right, the first transaction is recording depreciation expense on the plant assets. Before we talk about this, remember when depreciation is recorded, the journal entry is to debit depreciation expense and credit accumulated depreciation. Okay? It does not have a cash flow effect because it is what we call a non-cash expense. Right? However, even though it doesn't have a non-cash flow impact, it does show up in the statement of cash flows because in the operating activities section of the statement of cash flows, using the indirect method, which is the method we are using, we start with net income, and then we have to add back non-cash expenses. And we're going to work with this in a couple minutes. But because we have to add back non-cash expenses, and going back to our problem here, depreciation is a non-cash expense, it will show up on the statement of cash flows in the operating activities section. That O stands for the operating activities section. Remember, there are three sections in the statement of cash flows. We show the cash flows from three different areas. Cash flows from operating activities, cash flows from investing activities, and cash flows from financing activity. So that's what they're asking is which section of the statement of cash flows is this reported on? So depreciation is shown in the operating activities section, and it has no cash flow effect because it's a non-cash expense. It's the same thing with a loss on the disposal of a plant asset. When we are adjusting net income in the operating activities section, we are going to be adding back non-cash losses and subtracting out non-cash gains. So a loss incurred shows up in the operating activities section, but it doesn't have a cash flow effect. Okay. We acquired a building by paying cash. Acquiring a building is an investing activity. We are purchasing a building, paying cash. It's a cash flow resulting from investing. We are investing into the company. And if we are buying and paying cash, it will be a cash outflow. Here we made principal repayments on a mortgage. We are paying back a mortgage. A mortgage is a financing activity, the borrowing of money to buy a building. It's going to show up in the financing activities section, and it was the payment, so it's a cash outflow. Here we issued common stock. We issue stock to bring in cash to finance our operations. So the issuance of stock is a financing activity section. And if we're selling stock, we're bringing cash in. It is a cash inflow. We purchase shares of another company to be held as an investment. This is the investing activity. We're buying investments. And if we're buying investments, it's a cash outflow. Paid dividends to common shareholders. Paid dividends because we had issued stock. Issuing stock is a financing activity. And if we're paying dividends, it is a cash outflow. Here, sold inventory on credit. we sold inventory on credit, there is no cash flow effect, and revenues are reported within net income in the operating activities section. Purchased inventory on credit, same thing, no cash flow effect because no cash changed hands, and it is an operating activity. Paid wages to employees, that is an operating activity, and it is a cash outflow because we are paying wages to employees. All right, let's take a look at this exercise that has us preparing a statement of cash flows. So this is Scully Corporation's comparative balance sheets. So here is the balance sheet from last year, and here is the current year's ending balance sheet. It gave us additional information here. Net income, which would have come from the income statement, was $22,630. Company had declared and paid dividends of $19,500. All other changes in the non-current account balances had a direct effect on cash flows, except change in the accumulated depreciation. Land was sold for $4,900. Prepare a statement of cash flows from 2010 using the indirect method. Right, when we are preparing a statement of cash flows, the first section we're going to work on is the operating activities section. Now, you should have learned in your readings or in the in-class mini lecture videos, not in class, but the mini lecture videos, that in the operating activity section, we are trying to show how much cash was either used or provided by the company's normal operating activities. The best measure we already have of operating activities is the net income, because the income statement reports revenues and expenses related to operating activities. However, as you have learned throughout this course, net income is calculated based on revenues being recorded when they are earned and expenses being recorded when they are incurred. That means that net income is not calculated using cash inflows and outflows. It's calculated through accrual accounting. Thus, even though net income is the best measure of a company's operations, it is not reflective of cash flows. For instance, in this problem, net income was $22,630, but that doesn't mean that cash increased $22,630. As we're seeing here, cash during the year only increased from $10,700 up to $14,300. It was not the same as the amount of income. And that's because this income is accrual accounting, not cash flow. So what the indirect method does is it starts with net income. Here is net income that was brought from the income statement, and the problem here told us what it was. Through a series of adjustments, we are going to convert that accrual-based amount back to a cash flow figure. And that is done with this little chart, this little cheat sheet. Now, this chart is available to you in the textbook. In the textbook, it is illustration 17, so it's in chapter 17, illustration 11. Okay, so you can find it there as well. What it does is it says start with net income. Here's our net income. Then we're going to make all these adjustments to convert that net income back to a cash either provided or used by operating activities. The first thing we look for are non-cash expenses such as depreciation, depletion, and amortization expense. In order to figure out the amount of depreciation expense, normally we would go look at the income statement, but we weren't provided an income statement here. We were provided the beginning balance and accumulated depreciation. Last year's ending becomes this year's beginning, and this year's ending balance and accumulated depreciation. That means that we must have recorded depreciation expense during the year of $5,000. Okay? Thus, the amount of depreciation expense that we need to add back to net income is $5,000. So we have started to adjust this back to a cash flow number by adding back depreciation expense. Let's see, I don't think we have any other non-cash expenses in this problem. We don't have any depletion or amortization. So the next items we're going to look for are increases and decreases in the non-cash current asset accounts. Going to my balance sheet, I'm going to skip past cash and look at my non-cash asset accounts, current assets. So here's my one other current asset account, accounts receivable, and it decreased. It went from $23,400 at the end of last year to $21,200 at the end of this year. There was a $2,200 decrease from last year to this year. My cheat sheet tells me if I have a decrease in a non-cash current asset, I will add the amount of the decrease back to net income. So here is my decrease in accounts receivable, and it is being added back to net income. Let's look and see if we have other non-cash current assets. We do not, because these are long-term assets. So what's next on our list of adjustments? We need to look at current liabilities for increases and decreases. Looking on my balance sheet, I have one current liability account, accounts payable. Looks like accounts payable decreased and went from $31,100 down to $12,370. If I have a decrease in a current liability, I need to subtract the amount of the decrease from net income. So my decrease in total was $18,730. I will subtract it from net income. All right, I don't have any other current liabilities, so I am done with that adjustment. The last type of adjustment we need to look for are non-cash losses and non-cash gains. The problem told us that the land that was sold for $4,900. When I look at the land account, there was a decrease in the land account of $6,000. So we sold land, we decreased it $6,000, and we sold it for $4,900. If we sold land that had a cost of $6,000 and we sold it for $4,900, we must have recorded a loss on the sale of that land of $1,100. My cheat sheet tells me if I have a non-cash loss, I need to add it back to net income. Okay, so I am going to add back that loss of $1,100. Now, what might be a little confusing is we sold the land for cash, but the loss on the sale does not reflect the cash that was flowing from the sale of the land. Plus, selling land is not an operating activity. It is not a normal thing we do in day-to-day operations. It's actually an investing activity. So we are going to see the sale of the land down here. Okay? The only thing we need to do to convert net income is to go through these adjustments. Okay, so if it doesn't make any sense why these adjustments are being made, you can still successfully complete this statement by following these adjustments one by one. Okay, they will lead you through the adjustment process. What we have done now is we have gone through and made all those adjustments. So let's calculate cash provided by operating activities. We started with net income, and we had some adjustments added to and some adjustments subtracted from net income. When I combine the net income with the total of the adjustments, I end up with a positive $12,200 number. That means overall, operating activities provided us cash during the year, cash inflows of $12,200. The overall cash inflows exceeded the overall cash outflows from operating activities during the year 2010. Okay. All right, we are through the most difficult part of the statement of cash flows. The next section we need to prepare is the investing activities section. In this investing activities section, we're going to show cash flows from investing activities, such as buying and selling investments, buying and selling property, plant, and equipment. Okay. We previously discussed the one item that was identified in the problem as an investing activity was a land sale. We were told that the land was sold for $4,900. That means we would have had a cash inflow of $4,900 during the year. Okay. In addition to that, we don't have any other investing activities. However, they did tell us that dividends declared and paid were $19,500. So we are going to show a payment of dividends, and paying dividends on our own stock is a financing activity. So that will be reported in the financing activities section. It is reported as a cash outflow because we paid dividends. So that's why we're seeing it as a negative amount here. It's a cash outflow. Okay. One other thing we need to do is look at our balance sheet for any other things that may have had a cash flow impact. And looking here at our common stock increased from last year to this year in the amount of $6,000, which tells me that I must have sold stock. Now, this problem really didn't give us many details about why that changed, but we're going to make the assumption that common stock increased because stock was sold. If stock was sold in the amount of $6,000, we would have had in another financing activity of a cash inflow of $6,000 from issuing of stock. Okay. Well, I don't see anything else in here. Retained earnings change is a result of net income. So I think the only other thing we need to do now is just summarize our cash flow statement. If I take the totals from each section, overall cash provided by operating activities, overall cash provided by investing activities, and overall cash used by financing activities, if I combine those three, I have an overall net increase in cash during the year of $3,600. I can reconcile that to make sure I am correct by combining the year's increase in cash with the beginning balance in cash. If I take the year's beginning balance, combine it with the overall increase in cash during the year, it should equal my cash at the end of the year. And lo and behold, it does. Okay. Take a step back for a minute and look at this statement. Overall, what we did is we explained the change in cash. Overall cash increased $3,600 during the year, and we have shown that that increase was partially due to cash coming in from operating and investing activities, that a big chunk of cash was used for financing activities. Okay. Overall, we had an increase in cash, but this provides us more details about why or how. Okay. The last thing that this statement wants us to do is to compute the free cash flow. Free cash flow is calculated, and let me go ahead and just put it here, by taking the net cash from operating activities, subtracting out any capital expenditures, and any cash dividends. Okay. Thus, for this company, our cash flows from operating activities were $12,200. Capital expenditures means amounts that we spent on buying property, plant, and equipment. And we didn't buy any property, plant, or equipment, but we did pay some dividends. So we subtract out the dividends. So overall, we had a free negative cash flow of $7,300. Okay, which isn't necessarily a negative, a bad thing. Essentially, just what it means is we spent more money to finance or pay our dividends than what the operating activities provided. So it's not necessarily a bad thing as long as our overall cash increased. All right, let's try one more example problem just to give us a little bit more practice with this. And that is here from Mulder Corporation. Here are their comparative balance sheets for 2 years, 2009 and 2010. Additional information, net income from the income statement was $18,300. Dividends declared and paid were $16,400. Equipment, which cost $10,000 and had accumulated depreciation of $1,200, was sold for $3,300. All other changes in non-current account balances had a direct effect on cash flows, except the change in accumulated depreciation. All right, first section we're going to work with, that is the cash flows from operating activities. We always start with net income. Net income given in the problem was $18,300. We are now going to start making adjustments to get that net income back to a cash flow amount. First thing we need are the non-cash expenses. Depreciation. Normally, if we are given an income statement, we could just get the amount of depreciation expense straight off of the income statement. This problem is complicating it a little bit for us because they didn't give us an income statement. We have to figure out how much the depreciation was. We can determine how much depreciation was recorded during the year by looking at things that would have changed accumulated depreciation. Okay, so taking a look here, we started the year with $10,000 in accumulated depreciation. That was last year's ending. During the year, we sold equipment. When we sold that equipment, we would have decreased the accumulated depreciation account by $1,200. So here we're seeing that we started with $10,000 in accumulated depreciation. We subtracted $1,200 out of there when we sold that equipment. Then we ended the year with $14,000 in the accumulated depreciation account. That was its ending balance. Thus, if I had $10,000, I decreased it $1,200, so I ended up with $800 in accumulated depreciation. But I ended the year with $14,000, which means the amount of depreciation recorded must have been $5,200. That's how we ended up with an ending balance of $14,000. Okay, again, started with 10, we decreased $1,200 to end up with $14,000. The difference must have been $5,200. So we backed into our depreciation expense, and our cheat sheet tells us to add back that depreciation expense to net income. Here we go. Here we see that $5,200 being added to net income. The second thing we need to look for are increases and decreases in non-cash current assets. All right, let's go look at our first non-cash current asset. Whoops. We had accounts receivable that increased during the year. It went from $22,300 up to $25,200. The difference is $3,500. My cheat sheet tells me if I had an increase in accounts receivable, I need to subtract the amount of that increase from net income. So here we see the subtraction of $2,900, which is the difference between $22,300 and $25,200. It is being subtracted from net income. I don't have any other non-cash current assets because investments, equipment are long-term. The next thing I need to look for are decreases and increases in current liabilities. Going to my balance sheet, I have one current liability here. That current liability increased from $11,100 up to $14,600, an increase of $3,500. My cheat sheet tells me if I have an increase in a current liability, I need to add that back to net income. So here is my increase to net income for $3,500. Let me go back here. I don't have any more current liabilities, okay? The last adjustment I need to make is to look for non-cash losses and non-cash gains. Okay? The only thing that we sold during the year was this equipment. When I sold that equipment, it cost $10,000. It had accumulated depreciation of $1,200. That means that asset originally cost $10,000, it had depreciated $1,200. That asset was worth $8,800, and we sold it for $3,300, which means we took a loss of $5,500. My cheat sheet tells me if I have a loss, I need to add it back to net income. So here is my loss being added back to net income. I have completed all of the adjustments to net income. I can now finish my operating activities section. Net income plus and minus these adjustments leaves me with a positive $29,600, indicating that overall cash provided $29,600 by operating activities. Next section we need to work on are the investing and financing activities section. We had an investing activity here. Equipment was sold for $3,300. Selling equipment is an investing activity. The buying and selling of our property, plant, and equipment or investments are investing activities. If we sold it, it is a cash inflow, so we will show it as a positive amount. In addition to that, dividends declared and paid were $16,400. Dividends are a financing activity. We will show that as an outflow of $16,400. Cash was used to pay the dividends. Okay. We also need to look at our other accounts. The equipment account we already dealt with the sale of the equipment. Accumulated depreciation we've already taken care of. Bonds payable. It looks like bonds payable decreased, which means we must have paid off these liabilities. Paying off this liability, long-term liability, is a financing activity. We must have paid off $20,000, which means it was a cash outflow of $20,000. Common stock. We increased common stock, which means we had to have issued stock and been paid $5,000. That is a financing activity. Increase cash flow. I think we got it all. Yep, because we've dealt with accounts receivable. Oh, we didn't get the investments. I missed the investments. Up here, we had investments that increased, which means we must have purchased some investments. Investing activities, buying and selling of investments, provided a cash outflow or used cash because we purchased some investments, increasing our investments. Okay. All right, now I think I've got everything because we've dealt with investments, equipment, bonds payable, and common stock. So we've got our investing and financing activities all taken care of. If we combine the cash inflows and outflows from those two areas, overall, we ended up with a negative cash flow in investing activities, indicating that overall cash was used by investing activities. And in financing activities, overall, more cash was used than was provided, resulting in an outflow in cash used by financing activities. Combining the cash inflow from operating with the cash outflows from investing and financing, overall, more cash flowed out of the company during the year than what was brought in. I can see that and reconcile it here with our cash balances. Beginning cash balance was $17,700, combined with the overall cash outflow during the year, results in an ending cash of $15,200, which reconciles with the ending cash at the end of 2010. Finally, to compute our free cash flow, here are the cash flows from operating activities. And remember our formula, which is up here. Let me bring that back down so you can see it. Here is your free cash flow formula. So our cash flows from operating activities minus any capital expenditures. We didn't purchase any long-term assets, property, plant, and equipment. We sold some, but we didn't purchase them. And then we subtract out dividends paid, payment of dividends of $16,400. Overall, we had a positive free cash flow. Cash flows from operating activities exceeded capital expenditures and dividends paid for a positive free cash flow.